Welcome to the Finance Committee meeting. Start with a it's whakatauki view. Taka te hoa, ki te uru, taka te hau, ki te tona, ki makina kina ki uta, ki a makarata ki tai, I hi aki ana ti atakura, he tio, he huka, he hoho, ti he mori ora. Get ready for the westerly, be prepared for the southerly. It will be icy cold inland. It will be icy cold on the shore. May the dawn rise red tipped on ice, on snow, on frost. Sneeze, it is the breath of life. We have got winter coming.
-2 in the middle month.
-2 in the middle, okay. So it's usually twice what it's the lowest. Anyway, welcome all. Special welcome to Andrew Douglas, who's our co-chair of Audit and Risk, who's here for part of this meeting. And welcome to those online. And Phil Walken from JB Weir, who we'll be hearing from very shortly. The apologies that we've got for Alexa Forbes at the moment, that's the only one. So just like to ask that we accept that apology. Somebody to thank you, Alan and Kate, to set you back. We don't have a public forum, and our agenda is as printed. Just like to remind councillors, if there's anything that is a conflict on the agenda, please to defeat that interest. Now, Nick, do you have anything you want to say before we ask JB Weir to come along?
Yeah, I could probably just give a little bit of context to this, because this is not usually something that would come to the Finance Committee, but this has come from Audit and Risk, where if you remember, those of you who are on Audit and Risk and some of the other councillors that have been at the meetings, we had a review done in the last year, independent review. There were some recommendations that came out of that. We considered those or you considered those in the last Audit and Risk meeting. One, and Audit and Risk agreed to make some amendments to the SIPO, which will be going to the next Audit and Risk meeting to approve that, and then ultimately that comes to council. One of the items that was recommended was around including an asset classification for private equity investment. And we provided some information there, but it is a relatively complex area. And Audit and Risk, we made the noted that JB Weir would be prepared to come and do a workshop, talk to Audit and Risk about further details, give Audit and Risk the opportunity to ask some questions, particularly around the ESG implications of having classification in private equity. So we've teed that up ahead of the next Audit and Risk meeting. We were going to do a separate workshop, but just timing wise, and the fact that when we do a workshop like that, likely that everybody would be here, we've just put it into Finance Committee so that everybody that's here can hear it as well. And then following this, we'll go away, make any finalise those adjustments to the SIPO, which will be Audit and Risk in a couple of weeks. So that's the context of why JB Weir's here talking to you about private equity today.
Okay, thank you, Nick, and welcome, Phil. I presume you've probably got some slides that you'll have up for us, but just like to hand over to you and take it from here.
I do. I don't know what the easiest way is, whether you would like me to share them, or hi everyone, whether you'd like me to share the slides, or if there's a different way, I'm open to whatever's easiest.
Okay, if you share them, that would be good.
Okay, just bear with me. Also, my colleague Tom Phillips is attempting to try and dial in as well. I'm not sure if he's been left in the lobby, so if someone could control that, could let him in. I think he'd like to participate as well. So please let me know if you can see this.
Yes, it's coming through.
Great, I'm not sure I get on the right slide. So thanks for that introduction, Nick, and a bit of the context. Look, there's a lot in this slide pack, and I appreciate we probably don't have time to really delve into what is an exciting, but yeah, it is a complex asset class. We've also put just for because we haven't spoken to you for a wee while, and there's been lots going on in markets. So just a bit of background, just an update on performance on the portfolio as well, which I won't spend too much time on, but just out of interest, clearly, as you would no doubt have seen, it's been pretty chaotic. It's probably the easiest word to use in financial markets over the last month and a half, for kind of obvious reasons, but just rest assured the portfolio has been working very well and is still kind of resilient, very diversified, and withstanding what has been some pretty extraordinary levels of volatility, both on the downside and on the upside as well. So yeah, if we'd like to touch on performance, I can maybe perhaps after the workshop, and we can come back to those slides if you like. So I'll just jump through. So look, like I said, there's a lot of information in this, and I don't want to overwhelm you. I want you to just get kind of the key touch points on what private equity is, why it potentially could be beneficial for the regional council's portfolio, but also, as Nick highlighted, some of the other considerations you'd need to take into account if you wanted to go down this, and then obviously how you'd access it, what the costs are, and then potentially the return enhancement benefits as well. So please interrupt me if you have any questions as we go through. Like I said, there's a lot of info in here, and I want to make sure I'm hitting the right points to make it clear. So let's just start at the beginning. What is private equity? Well, in simple terms, really, it's just like taking ownership in a company. So yeah, whether it's full ownership or partial ownership, just like when you'd buy a share in Apple, it's the same as taking some equity, taking some ownership of that company. The big difference is, quite obviously, is rather than doing that through a public exchange like the New York Stock Exchange or the NZX in New Zealand, it is doing it privately. Now, again, there's different ways to do that. So it might be a case of the Otago Regional Council taking ownership or partial ownership in a pest control company, for example. But the most common way, and it's certainly what we're talking about in this instance, is using a private equity manager to then go out and own those companies, find those opportunities, and you invest in that vehicle and get the benefit of, or hopeful benefit of the ownership and the returns in that class. So those private equity managers or firms are looking at those opportunities, and it might be, depending on their mandate, it might be in a certain jurisdiction, like in New Zealand, or more globally, taking ownership of those companies, looking at opportunities, taking control, and eking out those returns, and then exiting those companies. So it might be listing them on a private market or on selling them to someone else, and then you enjoy the benefits of those returns. And so this diagram here just kind of shows how we at JB Were see private equity fitting within kind of the broad, diverse set of investment opportunities and asset classes out there. And you can see, it's quite a complicated diagram, so apologies for that. But on the as you go on the left-hand side and down the bottom left, you've got kind of your very defensive, quite easy to access traditional asset classes, cash, fixed income, and obviously the ORC portfolio has exposure to those. As you move upwards, you're taking typically more volatility, more risk, but this is in your traditional equity asset classes, so New Zealand, Australia, and global. And then within that, there's different kind of sectors and thematics you can get exposure to within those. As you move to the right, we start talking about alternatives or non-traditional asset classes, and these vary across a wide spectrum of kind of risk and return expectations. But private equity is typically viewed as a more volatile, or a more growthy part of that alternative landscape. So like with equity, you're taking equity risk, you're still taking ownership in a company, but you're doing it in the private space and not on an exchange. And so I won't delve into all those different asset classes, but that's where we at JBWere see private equity fitting. It is an alternative. It does come with some complexities that you don't necessarily get within traditional markets. But because of that, there's also some benefits that you may not get in traditional public listed asset classes as well. And look, there's a variety of different types of private equity, right down from kind of seed capital and venture capital up to kind of the growth and the buyout where you're buying into kind of very existing businesses, etc. And again, a variety of different risk and return expectations on the back of that. So again, please interrupt me if I'm rushing through this too fast or too slowly. So why is private equity exciting? Well, the universe is huge. Like we think of, especially if you think about the US public listed market, so the S&P or the New York Stock Exchange or the NASDAQ, these are big markets, but they are dwarfed by the size of the private market space out there. So you can just see on that top chart, just the magnitudes of difference between public equities and private. There's just so many more companies available. Now, accessing those is tricky, right? Then that's the complication here. But the variety, the diversification, the exciting innovation you can get on private markets dwarfs what you can get in public markets. And what's become interesting, and I think there's a variety of reasons for this, is that the number of companies on public markets has actually been shrinking, and that's where what those bottom charts are highlighting, and for a variety of reasons around compliance, just the fact that there's a lot of private capital out there now. That means companies don't necessarily have to have an IPO list on a public market. It means that companies are either never going public or taking much longer before they do, and so that's, well, as a investor in public markets, that is it may be a drawback, but it's also an exciting attribute to private markets that is becoming an interesting theme. And certainly in New Zealand, you could argue it's quite obvious when you think about the small nature of our equity market. There's more than 50 companies on there, of course, but we don't get a lot of new companies coming in. There's often they stay private or they're taken over by global multinationals or you name it. And so the private space in New Zealand is actually quite exciting, and it's less so in the public space. Not quite so diverse in the global scene. I'm going to swamp you with some numbers now, so again, bear with me on this one. Why is private equity we view it as a return enhancer in a portfolio? And why do we say that? Well, all this table is showing it again. Lots of numbers, but let me get into it.
The slides aren't moving forward on our.
Oh, aren't they?
Because I'm assuming you've moved past that first.
I'm on page 7 now. If that's helpful, I'm not sure how to.
Yeah, do you want to stop sharing and we'll start at this end and see?
Okay. Yeah, so apologies for that. Hopefully there hasn't been too much mess. So I'm on page 7 now. So you'll see a table, a very in-depth table of returns and risks and volatility, historical measures of different asset classes. So again, let's not get into the details too much, but what we typically view as private equity is a return enhancer. So why is that? It typically or historically has had stronger returns than other asset classes. And then this table, all this is showing is just confirming that. So the red circle there on the right hand side shows historical returns since 2000 for private equity. This is global, is grown in excess of 10% annualized versus other markets there, which have not grown as much. Now, US equity market has given it a run for its money. To be fair, it's been a phenomenal market over the last few decades. Questions obviously on whether that is going to continue or not. But what is also an additional benefit of private equity versus, say, public markets or traditional asset classes, as you'll see there, is it has stronger returns and lower historical, or in a historical sense, lower volatility. So for the return benefit you get, you're arguably exposed to less swings than you are in public markets. And why is that? Well, these markets aren't trading on a day-to-day basis. You're not getting prices moving by minute to minute, right? You're not exposed to the whims of Trump's tweets or earnings announcements or central bank announcements like you would be in public markets. They're not moving around as much. Private markets, clearly they might only revalue every quarter or month or when a new capital raise is done. So in a nutshell, because again, we could really get into the weeds here and I don't want to swamp you with this, the theory behind why people would and why private equity is seen as a benefit to a lot of investors with long-term horizons is that it enhances returns. You have stronger returns and lower volatility. And that's really achieved by, like I said, these private equity managers taking control of companies and getting alignment, driving those efficiency gains, etc. There's often differences in information access. So in public markets, companies are required to disclose any meaningful information on a regular basis. That requirement's not as pressing in the private space. So those managers can take that information advantage and use it. There's a liquidity, and so there's a premium there. Look, this is one of the drawbacks of private equity. It's hard to get in and out of these companies, clearly. But also and then this is going back to the slides previously, because the private asset space is so huge, and when you think about it, these companies might be small and innovative and not got large enough to list on public markets yet. You're accessing to this new exciting innovation that you may not have access as easily to in public markets. And this is kind of historically what's driven these better returns. So in a kind of a very quick summary, the market is huge, the opportunity set is huge, the historical returns are higher, the volatility is lower. That all sounds wonderful. But, right, and this is the drawback, clearly, is there's some difficulties to accessing this market. So now on page 8.
Yeah. Oh, can you hear me?
Yes.
Just a quick question.
Yeah.
Just in regards to the annualized return for private equity, it would, well, my understanding is that there's not probably a dividend stream that comes from private equity like you would have from publicly listed companies. Is that annualized return sort of a return which is based on the increasing value on that private equity investment, or is it I mean, where does the money come from?
No, that's right. It's maybe based on distribution, so that's on exits. So yeah, this is be an index, and again, it's be a complicated way to do it, but this is as an investor, you've invested into a private equity manager, and your return is not based on kind of just them guessing what the value of that company is. It's actually the distribution they get. So they're exiting, they grow that company, increase its multiple, and then sell it to someone else or list it on a public market, and that's that return that you get. And then obviously how long that's taken to get and the costs involved in doing that, that is what that figure is. And I can kind of touch on, actually, it's a great question. The next slide kind of goes into some of the issues with that as an investor and how you access kind of these different markets. So
Phil, sorry, it's Tom here.
Yep.
I was just going to add to that, because of the if ORC decides to in fact have a private equity allocation, the way that we would look to access it would be through a fund of funds. So that what that means is that is an existing fund. So it's got that returning return on it. So it's already been going, because normally a private equity works on a J curve. So you put your money in on day one and you don't get your money, start getting your money back until about 4 years down the track. By going through an existing fund of funds, we would be able to access that cash flow in the form of a return of capital from day one, not having to wait for 4 to 5 years in order to do that.
Yeah, thanks, Tom. So that's kind of what the next few slides are really going to talk about is, yeah, private equity. I'm painting a really bullish picture, right? It's a wonderful asset class, access to these huge markets, historical returns and volatility are beneficial versus public markets, but it's not for everyone. And there's some complications about getting access to it. And there's ultimately two ways, like Tom highlighted. And this is kind of going back a few more years now, kind of the only real way was through these closed-end funds. And so this really, the slide on page 8 is highlighting the kind of the considerations, the complexities with these, is that as you give a closed-end fund would have a defined endpoint. Effectively, eventually, all these assets it will own, it will sell, and it will distribute. So that's what closed-end means. It's got a finite life. These firms would raise some capital and then go out and invest in, let's just say, 10 different companies. And then as those companies mature and grow, and fingers crossed the manager's a good one and they add some value, they'd start to return those distributions or maybe even ask for more capital depending on how things are going. And that's what this J curve thing, you might have heard of that term before, where actually your returns as an investor will probably be negative in the near term as they do capital calls and require money from you, and they invest it in these companies before they get that growth, that profitability uptick, the valuation uptick, and then they get those exits where they can then sell those companies and distribute the returns from that back to the investor. Those funds are liquid. Effectively, you're locking your money in for a long period of time. It might be you won't get the first returns back until 4 years, like Tom said, but ultimately you'd need to look at them maybe on a 10-year horizon. There's cash flow complications with all those. You've got that J-curve effect. And then you are putting a lot of faith in that manager to do well. Now, what I would highlight with private equity in general is when you think about managers, investment managers in the public space, often you'll find it's quite difficult and very difficult, in fact, probably for one manager to outperform consistently over time. In the private space, that has become, it's more obvious that you see that. Those top performing managers have a higher propensity to continue to perform well over a long period of time. So if you can find one of those managers, they're actually quite well sought after. And one of the growing challenges actually getting access to them. They often, because of their demand, they make it the hurdles for investors to get access to those, whether it's the minimum capital requirements or just only opening it to existing investors, they're becoming harder to access. And then what is also really a really important consideration if you're thinking about private equity and these closed-end funds is that in an ideal world, you'd want to diversify. You'd want to have a number of different funds across a number of different managers, across a number of different regions. And if you can imagine, that takes up time and resource to be able to do that. And the chart on the bottom kind of shows the importance of doing that, is that these are the returns of different vintages and different funds across the years. And as you imagine, it's cyclical depending on the economic cycle, and there's a variety of different returns depending on managers and things, but you'd want to spread that risk. You wouldn't want to be all investing in private equity on for 2025 and waiting for those returns to all mature at the same time. You want to be spreading your maturities and your distributions and your diversification across a variety of different managers. So that's why closed-end funds are not for everyone, and it's certainly not what we're recommending for the regional council. Instead, what we're recommending, and what would, if it was perceived as ideal, so just on page 9, is what Tom highlighted as a fund of fund approach. So this is where you invest into a vehicle that has already access to all these different private equity managers. Maybe it's investing on its own, but also through a variety of different managers, different jurisdictions. It's already accessing a very mature investment set. So some of these investments are about to exit, some of them in early stages. And so whereas if you just went into one single closed-end fund and you face into that J curve, which is that left-hand chart there, what an evergreen or open-ended fund or a fund-to-fund approach is it's constantly it's churning. So new investor money's coming in at the same time as it's selling down on some existing assets, and you're getting that ongoing churn, and it's an existing turnkey exposure, effectively, to a very wide, diverse set of private equity assets. And the additional benefit of this is, whereas closed-end funds, effectively you have no liquidity, you are in there for perhaps 10 years. Evergreen funds or open-ended funds typically have access to liquidity. Now, they're not liquid, don't get me wrong, they're not liquid, but they have access to liquidity on a monthly or quarterly basis. And that is obviously an exciting attribute, because that means, as an investor, you can take advantage of those return and volatility metrics. It's something you can actually act on. So if you see a strong period of returns and your exposure to these funds has done very well, and you want to take some profits, you can actually do that and rebalance your portfolio in an asset allocation sense, where you cannot do that as easily in closed-end funds. So that's really what we're recommending for the regional council, is that private equity is a great asset class. It comes with complexities. That means it's not for everyone. But these open-ended structures, these fund-of-fund structures, which you basically just invest in one manager, and then they're investing in a variety of different managers, removes some of those complexities. And yeah, you have a diverse turnkey exposure already, and you don't have that J curve and the illiquidity, or the same degree of illiquidity that you would in a closed-end fund. Now, again, there are some considerations here, and one of those is fees, right? You're paying a manager to go out and do all that due diligence for you, that manager selection, creating that diverse investment vehicle for us to get easier access to. There are clearly fees that cost them to do that, so you pay for that. And the fees for private equity and for open-ended structures are much higher than they are in traditional assets. But what's really important to consider is all the analysis we've done on the return enhancing potential are net of fees. So even with those higher fees, they have historically generated higher returns. So that's, yes, you pay for it, but the return enhancement is net of fees. So it's even beyond that. The second consideration, and this one's a really important one for the council, and Nick obviously touched on it, is that because you're giving control to a third party effectively, and then in turn investing in other products where they might not have direct control, this is where it gets important if you have kind of really strict or ESG or responsible investing values that you want to maintain. And this is where it gets complicated, right? And this is really, I think, the next slide. Sorry. I will pause there. I just want to touch on slide 10. I've jumped the gun a little bit, so apologies. Just on the return enhancing benefits first. So just on the next slide on page 10. This is the analysis we did, and I believe you may have seen it. It was in one of the notes we sent around. I'm not sure if it got tabled or not, but this is the modelling work that we've done just to highlight what would be the potential return benefits, expected return benefits for the ORC portfolio if we were to, as the review recommended, take the 5% allocation out of New Zealand listed property. So this is like your Precincts, your Kiwi property, your Goodmans, and put it in global private equity through a fund-of-fund approach. And the numbers there are small in benefit because we're only talking about 5% here. So this is really what we need to weigh up, is whether the return enhancement is enough to offset the other considerations. So this is really what that modelling work on the left-hand table shows, is taking the 5% out of listed property, putting in private equity, that we'd expect over 10 years, these are annualized benefits, you'd lift by around just over 20 basis points per year. Now, you compound that up, that actually matters quite a lot. And you're talking on a 10-year horizon, I think it would add an addition, what was the number? I think it was around 1.5 million to the portfolio, all else being considered, with some lower volatility too. So when you put some absolute numbers on it, the figures are large, but they're small in an incremental basis. What I would say is if we decide here that you decide, I should say, that private equity is not what we're looking for, just, yes, we get the return benefits, but there's other considerations we're not happy with, what we'd recommend is still taking that 5% out of New Zealand listed property and actually putting it in global equities. And the reason I say that is, one, there'd be a very small expected return benefit, but the New Zealand listed property space is quite small. There's only approximately 10 or 12 listed companies, and some of those are so small that they wouldn't be in our universe. Whereas global equities clearly is a far more diverse exposure. So we'd actually think that we'd recommend a SIPO change just to switch that 5% into global equities to make that 20%, if you weren't comfortable going into the private equity. So the modelling work we've shown, and the table on the right just shows the return and assumptions that we've used to get there, does show a modest, admittedly, pickup in expected annual returns. But if you annualise that, compound that over a 10-year horizon, the absolute numbers are relatively large. But I kind of jumped the gun on this. If we jump to page 11, the big consideration for the ORC is that return enhancement enough to offset potentially having to perhaps have a carve out for your responsible investment policy. And I know you did a lot of work through this over the last couple of years and on that, getting this policy all up and down, and clearly it's working. And because we invest in equities directly, we can manage to this. But under a fund of funds model, and certainly when they're then investing in different private equity firms around the world, they're giving up control. And so it's more difficult for them to then say, look, this is the ORC's RI policy, you need to manage to that, because clearly, as you can imagine, the numbers we're talking about here are too small for those firms to then start to dictate where you invest and where you can't. So what we can do, and there's ways to get around this, is we can try and align your policy as best we can with the private equity managers we've recommended. And you would have seen in that note, or may have seen in that note, that I did some analysis looking at each of these managers' own exclusion policies. And they do have some reasonable alignment, but it's not perfect, right? And it's tricky because we're talking about companies that don't disclose as much information, so you don't exactly know where all their revenues coming from. Again, they might be investing in a vehicle where another manager's taking care of it, so they've had to release control. And so what we typically see from our other institutional clients that have gone down this road, in order for them to do this, and it's quite common, don't get me wrong, this is not unusual. You see it across the KiwiSaver space, you see it across just other institutional space, is that investors like yourselves will have an RI policy, but then within that, they might say for private equity or for third pooled vehicles like this, they try and do their best to align the policy as best they can, but they unlikely to, so they have a carve out. So it's quite, like I said, it's very common, but you just need to have comfort with that the investing in a fund of fund approach, it may mean that you invest in some companies that don't completely align with your existing RI policy. And because it's private equity and you're giving up control, whereas if, like we said, we find something that doesn't align with your portfolio, we can divest out of it tomorrow. That's not the case in private equity. You can't necessarily do that. So that's really, I know I've taken a long time to get there. That's really the issue we're at here, is that we think that there is a return benefit for the regional council to having a small allocation to private equity. It's a great asset class, less volatile. However, it's whether you're comfortable, one, with the fees, but also with perhaps having to have some flexibility in your RI policy and potentially investing in companies that may not completely align. Now, they'll be small, don't get me wrong, but that is the consideration. So I've absolutely rushed through that. And like I said, I can go back and delve into things if it's a little bit easier, but happy to hand back to you, Chair, if there's any questions from the floor. Or Tom, if I missed anything that you think is worth highlighting on any of that.
Okay, thanks, Phil. Tom, did you have anything that you wanted to add?
Yeah, thanks. Look, the only thing I'd add would be, sorry, can you hear me?
Yep.
Yeah. Sorry, the only thing I'd add is the reason why I recommend if you don't go down the private equity route, removing listed property is really also giving you significant property assets in the region, particularly around the port. We've already got significant property assets, and the benefit of having 5% in listed property really in our view, outweighs the benefits you get from diversifying away from that asset class. So it's sort of, you don't go private equity, you should remove that asset class, and that's in line with the.
Yeah, I think we might have just lost you, Phil. You faded out, but we certainly picked up what you mentioned there about listed property and our involvement with Port Otago and their property portfolio. So yeah, that point was fair. Thanks. Look, we'll just open this discussion up to council if you have any questions. Yeah, Elliot.
Yeah, to totally take the point around wanting to sort of move away from that New Zealand property asset class. I was just wondering if you had thoughts on, because you said if private equity wasn't the route we wanted to go down, you'd be recommending global equity, that kind of each one. Would you have concern around that potentially, instead being New Zealand equities? Are there downsides to that versus the global equities?
It's really, I can touch on this, Tom. It's one, there's a couple of considerations, but the ultimate one is around diversification. As you may or may not be aware, the New Zealand equity market is quite small. Yes, there's some kind of benefits to having that home knowledge, and we think we're reasonably good at getting access to the opportunities set there. But the New Zealand equity market, well, the NZX 50 is 50 companies. That's your benchmark. But even within that, some of those are quite small and illiquid. So we probably, the opportunity set is a bit smaller than that. Whereas if you go globally, there's clearly a much, much, much larger universe for us to try and get exposure to. So it's, the ultimate answer there is diversification. And yeah, looking at your asset allocation now, where you have 5% in New Zealand listed property, and then 15 in New Zealand, Australia, and global. Most of our clients would have a slightly larger exposure to global anyway. So this wouldn't be an unusual shift, and what we wouldn't be and not unusual, and certainly something would be consistent with what we see and recommend across other clients similar to yourselves.
Thank you. Look, thanks for that clear explanation and presentation. That's really good. My question is about our processes and what exactly is our decision-making process on this from here. I'm not sure who wishes to answer that.
Or in our processes. Oh, sorry. In our process in respect of what?
I guess there's a suggestion here. We might wish to make a change to our SIPO, and that's around either the private equity and then the implications around our responsible investment decisions, or this other suggestion of moving to global equities. Where does that decision get made and how?
Okay, so we've got audit and risk in a couple of weeks. At previous audit and risk, the subcommittee had agreed on making some tweaks, nothing minor that came out of the review. So the SIPO will be updated to reflect those, and then following this discussion, here, the bit that we have to put in there is, do we recommend a change to bring in private equity or not? Yeah, so that will go to audit and risk in 2 weeks. Makes the decision on whether that change would occur and happen in SIPO. And then, depending on whatever audit and risk recommends, goes to the following council for approval, because it's full council that approves the SIPO.
Okay, so that question, do we move to private equity, will go to the next audit and risk meeting.
Yeah, this workshop was just about giving everybody a better level of understanding about what it means, so that when you make that decision, you're better informed.
Okay, thanks.
Nick, sorry, if I could just add in there. think tied at the decision would have to be a willingness of council to have a carve out from your current RI policy if you were to accept private equity.
Yeah, that would be included in what goes to audit and risk. We'll be saying private equity, you know, we can effectively, the SIPO can be amended to have it in or out. Here's what it would mean, and it would mean adjusting the ESG policy to effectively carve out private equity. So, you know, from that point, yeah, audit and risk can make the decision based on that.
Phil, just a quick question. In regards to the percentage, it's 5% of the growth assets, which is 2.5% of the total portfolio, I guess. Total portfolio is 29 million. We're not talking about a lot of money really invested in private equity. It's about 700,000. Is that worth it? Or should we be thinking of a higher percentage?
Well, then, great question. I'd look, yes, if you ask me if you're comfortable around the ESG and the RI exclusions, then I do think it is. The benefit of these managers that we recommend these fund of funds is that the hurdle to invest is not that large. So if you wanted to go to a closed-end fund, it could potentially be ticket sizes of $1 million minimum. So you do have the ability to get access to these. And what I would say is because of your other attributes, your long-term focus, having that exposure to private equity, I think is beneficial. That's small, like you say. We're talking 5% of your growth assets, so it's not large, but that's something that look, if you get comfort with it and the nature of how it behaves, it's less liquidity than traditional assets. That's something perhaps we could revisit down the line. Maybe you could look to upweight it down the line. But I think because of its complexities, we'd often recommend just a kind of a gradual approach, right? We wouldn't recommend taking a larger chunk of your growth assets at this stage, but that's certainly something down the road we could revisit if you're comfortable with how it's behaving.
Thanks.
Thanks, Phil. So it's been good to understand that I guess this is just one slice of the total portfolio, and that there's you've invested in a lot of different areas in terms of their cash bonds listed. And this is sort of the private equity element of it. Just to touch on that ESG part a bit more, I know that for the rest of the investment portfolio, before we had the recent ESG policy come in place, there was sort of a minimum baseline that was applied anyway in terms of ESG thresholds. So could you just touch on that again in terms of the private equity? If it was to go in there, how much do you know about what that sort of that those funds or funds of funds doing in terms of just applying their own ethical lens over what they're investing in? Because I think that's quite a
So no, I didn't touch on this because I was just worried about time. Just on page 12, so our sorry, just share the screen again. On page 12, our recommended fund at the moment is Hamilton Lane. They're one of the largest private asset markets managers in the world. There's a bullet in there showing their current exclusions policy, and so they don't invest in, or where they have control, where they have discretion, they don't invest in companies that are involved in thermal coal, oil sands, non-sustainable forestry practices, controversial weapons, abusive lending practices, pornography, animal cruelty, child and forced labour, human trafficking, and tobacco and nicotine production. So there is actually quite a good alignment with your current RI policy. Where the complication is though, is that on a lot of your screens, your exclusion screens, it's done on a revenue threshold basis or any exposure. So if any company is involved in controversial weapons, that's the immediate no. where you have less understanding with these private managers, and particularly because then also they're giving control away to another private equity manager, you won't know often where those revenue thresholds are. And so you might find a company that 99% of its activities are involved in something that you'll fully agree with, and then there's a 1% they have exposure to something that doesn't align with your values. Based on your current RPI, so we can deal with that because we have direct control of what we're investing in. You won't necessarily have that. Now, again, in practice, everything's probably going to be very small if there is some exposures, but because we don't have that visibility and control, and the manager itself won't be able to as well guarantee full alignment with the way your RI policy is written at the moment. We'll do our best to, and again, the Hamilton Lane have their own policy that has reasonable alignment in my view, but there's no way we can, and they wouldn't say it either, they can guarantee that they wouldn't own something that wouldn't completely align. So it's around that visibility and control. As soon as you start giving up that, then it's really difficult to assure that you're completely meeting your policy as it's written today.
So just thinking through it a bit more in terms of this ESG side of it, how would we compare to other people around the country in terms of managing this? And if we just took one of the big names, so the New Zealand Super Fund, do they invest in private equity, and would they have this sort of lens over it too?
Yeah, so again, we've got to think about quantums here. So there would be ways for you to do it if you had a segregated mandate with a specific manager. You say, look, I have this pool of money, go invest it in the private space to these conditions, and they'll be able to do that. Problem here is, and I think it was you that highlighted it, we're talking about a small quantum of money, $700,000 perhaps. And so they wouldn't even answer the phone for you to do that. So the segregated mandates, you're really talking hundreds of millions of dollars to be able to do that. So that's where the super fund clearly has that ability. What I would say is that you would not be unusual, whether it's the KiwiSaver space or in some of our other space, to have a potential carve out for private equity. Just be given this. Everyone looks at the attributes and they welcome it and they try and get alignment as best they can, but there's no way to have that 100% assurity. So within their policies, they just say, look, we attempt where we can to have full alignment, but appreciating third-party vehicles, we don't have that direct visibility and control. We exclude this asset class from our RI policy. So that would not be unusual. So yeah, rest assured that that's the case. And we can help you if you wanted to. We can help you with some wording along those lines to kind of get comfort around that. But it is kind of common in these vehicles to have to try and kind of carve out when you have kind of strict policies like the council does.
Yeah, I think probably just the other way to add to what Phil said there to answer that question is probably ORC has a more restrictive ESG policy than the super fund or than most of, sort of the other institutional market in New Zealand. There's nothing wrong with that. That means when you're looking at other asset classes out of the mainstream, we have to look around to see where we can get the best alignment. And Hamilton Lane's alignment is the closest that we can find to your policy. As Phil said, it's not exact, but they do carve out considerably more than most alternative fund managers would carve out. So it's not 100% alignment, but it's as close as practicable. But really, I guess if the simple way to, again, you talked about that decision-making tree, is if you can't relax the ESG carve out for PE, then the answer is a no, and you look at the option B, which is to remove New Zealand listed property and put it in global equities, which would help your diversification because it's a far greater investable universe than the New Zealand equity market with the ESG policy overlaid.
Yeah, just it seems to me that this is all about diversification, investing in the private equity market. But my question is, how common is it for a public entity to invest in the private equity market?
I think it's becoming more common because these open-ended evergreen structures are becoming more accessible for these type of clients, even right down to the mum and dad investors as well. So private equity used to be quite an exclusive club because it was complex and difficult to get access to. Private equity managers are making it easier. So I think that's growing. That's why you're seeing it even in the KiwiSaver space. So right down to just the mum and dads on the streets are getting increasing access to these private markets, which, like I said, they've got attributes that we're excited by, but there are some considerations. So when you have your ethical policy, you just need to have comfort that you are giving away a little bit of control that you don't have at the moment.
But without expressing a view, we're dealing with ratepayers' money, not our money, someone else's money. So traditionally, councils have taken a pretty conservative approach. So I suppose that's sort of banging around in the back of my head right at the moment. There's a certain percentage of the people who represent that, when you talk private equity, that scares the living daylights out of them. But but appreciate the information.
And certainly we'll be following up with a further discussion at Audit and Risk around this whole issue. So well, unless there's any more questions, appear to be. Thank you, gentlemen, for your presentation. Phil, you were just going, I think at the start, you might want to give us a little bit of an update of the fund performance.
Yeah, of course, yes. No, I wasn't aware we had enough time. So yes, if we just, again, share the slides, apologies. And Tom, chip in here if you'd like to add something as well. Look, clearly, it's been an incredible period in financial markets, but we're quite happy with the way the portfolio has been going. Up until over the last 12 months, it's up it's nearly 7.5%, so slightly outperforming, and there's some reasonable outperformance across most asset classes. What's also reassuring is up until the 12th of May, which is when we had to have these slides to Nick, the portfolio had added a further kind of 1% or 320 odd thousand. So, and if you recall, halfway through May, that had some really, really amazing swings in financial markets as Trump was playing shenanigans with tariffs and rolling things back and you name it. So the portfolio is proving very resilient through all this volatility. We're quite comfortable with the way it's behaving, and then it's got a reasonable track record of performance there. So quite comfortable with the way it's performing. Tom, I don't know if you had anything you wanted to touch on.
No, that's a good summary, Phil. I think just for the benefit of the councillors, obviously we've been through, and we're still frankly going through an extraordinary period of global policy making or not making, depending on which way you want to look at it. And the main thing we did through this period is, we stayed calm and backed the asset allocation that we've got for the Otago Regional Council, which buffers you somewhat from the volatility, given you've got a 50% allocation to the fixed interest and cash. But the equities, by holding through that period, markets are up about 3 percentage points from where they were pre-Independence Day, as we call it, on the 2nd of April, sort of peak globalisation. And so, we held our nerve, and the portfolio is reaping the benefits of that now. Ultimately, this discussion we're having today was sort of brought about by one of the comments, in that review document. So, we view it very much as a council to make, and we're just happy to guide you along that journey and answer the questions you may have on the way. But that follow-up to that question that Phil answered about public entities, most public entities, if you think the fund, the APM fund, most large, local body institutions would now hold private equity in their portfolio. And that's partly from a diversification and, risk mitigation strategy as well. But again, It's a different asset class, so it's one that needs to be explained and thought through properly before going into it.
Okay, that's really good. Thank you very much, gentlemen, and we'll move on with the rest of this morning. So we'll catch you again sometime.
Appreciate the time. Thank you, everyone.
Thank you.
Yeah, go for it.
I've just got a bit of a question. So, really good presentation. Thanks for that. But my question is, at what stage do we actually look at why we have an investment fund and what its purpose is?
Yep. Okay. Well, I think we can add that to audit and risk discussion if I just want to do some preparation around that.
Yeah, well, and I mean you can look at that at any point, but it's really something that we look at all of that when we do the LTP and the financial strategy. Having the investment fund and the returns from that. That's what we considered, and it's all detailed there. Why we've got it, how we use it in the financial strategy. Updated every 3 years for LTP, but if you want to, have a separate discussion, you can do that at any point.
No, thanks. Thanks.
It's a worthwhile discussion. And yeah, I think perhaps around annual planning, long-term plan.
Right.
Okay. Does anyone else want to have anything to add after that? Andrew? Yeah.
Sorry to go on about this, but if you look at Port Otago, 20 years ago, they were 70 mil, with the property company, now with 800 mil. We're blessed with having a considerable amount of equity, and other regional councils may well be in a similar position, but I'm just a bit nervous about any change going forward because that's the past that we've really well. I do get the thing about diversification. Yeah, to get that. But I shouldn't be expressing the view at this early stage, but
yeah. Well, look, we'll talk about it further with risk in a couple of weeks' time. So, what is it next week? I'm not sure, but certainly let's continue that discussion. And Elliot,
Confirm that's coming back to council as well after audit and risk.
Oh yeah, it always does.
Yeah,
that's right. Good. Okay. So for the rest of this meeting, we need to confirm the minutes. Thank you, Andrew, for your attendance. So the minutes of the meeting held on the 20th of February 2025 are there. Should I have somebody to move those? Thank you, Kevin, and second, Alan. Thank you very much. All those in favour, please say aye. Aye. Against. There's actions from the resolution of the committee. We're still looking at the adding of carry forward balances on our activity reports. That's going to happen.
I was just confirmed because I had discussed that we will have those in for end of year, so effectively quarter four reporting, and then look to have them as part of quarterly reporting in the future. Yeah. That'll be just to ensure that council is aware of reserve balances and then ultimately also the forecasts on those reserve balances depending on where we sit.
Yeah, good.
Sorry. Yep. Sorry, Chair. The action, and I'm not sure if it came out of the Finance Committee or the Council, but for the purposes of the annual plan, we had moved a motion at some stage to get a report on work programs, or at least the and we haven't got it yet on the submission, so I'm just wondering when that's coming. This is the one for next week's annual plan, and presumably that at some stage.
Yes, I'm happy to let you know. We'll email that out to councillors tomorrow, Friday, alongside the agenda going out for the deliberations and hearings.
And just to manage, as I emailed around about this, just to manage expectations, I'm aware of the in terms of the work plan that you're talking about. This will not be everything that's been asked for, but it's certainly we are trying to move in a way that enables greater transparency for councillors in terms of individual work plans by team. So you'll get something with the pack tomorrow to be part of deliberations, and obviously there'll be some feedback on that and we can continue to have a look at it. So that's been incorporated into the work that the management look after.
Right, okay, we can move on to the quarterly financial report. Nick, you presenting that?
Yep. Good. Okay, I'll just give you, I'll give you sort of the key headlines, largely what's in the report, the cover paper, and then no doubt you'll probably want to go through some of the individual reports, and I'll let you sort of lead that, Tim, and we can answer individual questions. But as per the summary on the first page of the report, which is page 7 of your in Diligent, we've got an operating surplus for the first 9 months, which is just slightly under $12 million. That's $8.2 million ahead of budget for the 9 months. The biggest driver of that is the gain on sale of the Birch Kitchener property, which obviously that's coming in this quarter. It wasn't in the December Q2 report that you got. Happened, that sale was concluded in February. So that's 4.5 million of that surplus, and obviously there wasn't any budget in this year for that, because that sale had been included in the budget for the previous annual plan year, not in year 1 of the LTP. It just took us a bit longer to get everything completed. If you then, where does that leave us for forecast? Forecast then has us, we're forecasting the overall surplus to be 5.8 million. So that is 6.2 million ahead of a budgeted deficit that was operating deficit of 418,000. So again, that forecast includes the 4.5 million gain on sale from Birch Kitchener. So excluding that, the rest, if you like, the underlying surplus is forecast to be 1.7 million ahead of budget at year end. We go through the next page, so page 8 in the discussion section. Basically, we've done the variance analysis of the year to date. Variance, the surplus deficit variance, so we can see the areas where either additional revenue or more or less cost is creating that $8 million surplus variance. Then in paragraph 12, we've got the same table that outlines the key drivers of that 6.2 million variance in the forecast. And then following that in paragraph 14, we've then done a funding impact summary. Now, we did these previously. It's not the full reserve balances, which, as Richard mentioned, we're working on that, and we'll have that for year end and produce full reserve balances for for next year's quarterly reports. But what this shows is of that 6.2 million, where that additional surplus or deficit flows into reserves, because whenever you've got a deficit or a surplus, it's ultimately because we've already done our rating for the year. It's going to end up in a reserve. So you can see the biggest part of that, the 4.5 million, ends up in other reserves, which is the building reserve. That's where we budgeted it to be in last year's annual plan. The remaining 1.6 million, the bulk of that, 1.4 million of it, will be attributed to targeted rate reserves. And then there's the smaller amount, there's just under 300,000 effectively is funded via the general reserve. There is obviously overs and unders within the activities. The biggest one where there is an over, extra surplus, is in that water activity, which is the spend obviously for the Land and Water Regional Plan this year that we've forecast to not be spending that. What we're doing is we've ring fenced that. We're carrying that surplus forward into the annual plan for 25-26, so that we don't re-rate for that activity or planning activity when it occurs next year. Then in the discussion in the next section, so starting on page 11, we've done
Just pause you there, Nick. Michael, you've got a question. We'll allow you to have that now if you want.
Sure. Well, I was going to raise a question about paragraph 25, Mr. Chairman. Have we got there yet, though?
Right. So perhaps we'll let Nick get through to that, and then
Yeah.
you can ask.
Thank you.
Could I just ask on one that he's just mentioned?
Sure.
Yeah. So Rick, Nick, you said the 1.4 will be going back to a pool of targeted rates, the surplus. So that will be any amounts will be going back to the targeted reserves where the activity was rated from.
Yeah.
So if I'd rated for river management and I hadn't spent that, and that generated the surplus, would go back in those specific.
In whatever district it happened to apply to.
Yeah. Thank you.
Gary, have you got a question sort of following?
Yeah, just on the table where it's showing the unders and overs, we've got a $500,000 increase in fees and charges. Where exactly are the fees and charges? Which sector across the region are they attributed to?
It's regulatory fees and charges. So it's in consents and compliance. So consent fees are higher than we budgeted. There's also compliance fees that are higher than what we budgeted, particularly in the what's deemed the major clients. And some of that work that it's where we charge fees for some of the hearings work, like around landfills, the landfill hearings that were going on, and there's other major clients as well. But it's consents, it's regulatory fees and charges, it's consents and compliance.
But that's a substantial increase. That is, was it anticipated that costs were going to increase to our ratepayers or to the people who are applying for consents to that extent?
Going to add into that, Gary, around 140,000 of that 500 is revenue from secondments. Richard talked to you yesterday about the national replacement of the new consenting and compliance system. So we've got some staff seconded to the national body working on that. And so 140,000 of that revenue is from payments from that national body. The rest is around an increase in consent processing. And as Nick said, some of the fixed fees for performance monitoring being above budget, but reflective of actual work.
I'll just add, sorry, Gary, just add a little bit more. So the challenge we've got in the regulatory space is we can't anticipate the regulatory workload. So we build a budget based on the staff numbers, and then the revenue and financing policy as a percentage of cost recovery is then gets budgeted as revenue. If we have significantly higher workloads, then obviously we are charging more fees and charges as they come in accordance with those in accordance with the fees and charges that you set. So it's not a perfect science because we never know exactly what the workload will be, and we also don't know what the compliance workload will be in terms of what our focus will be on, and whether that's all cost recoverable or it's more incident response, which doesn't give us that same opportunity. So we just need to be confident in our processes for time recording and invoicing, and obviously we can look at it each year as we set the budgets, but it's hard for us to be well, it's not hard, it's impossible for us to be 100% confident because we just don't know what the incoming workload will be.
Okay, thanks for those explanations. I think just what I observed that year on year, we increase our fees and charges, and we also increase the activities we look to consent, and it does appear to be reflecting in these sorts of increases in revenue. So, okay, thanks for the explanations.
Okay, Nick, you can carry on.
Where was I up to? Oh, transport section. Yeah, so So we then did in the discussion, we did quite a bit of analysis over the last quarter on transport. The previous quarterly report showed, there was variances to budget in both of the networks. And although the variances that are here are relatively similar and in line with what was there, we've gone through and done quite a lot of analysis just to make sure that we've understood exactly what's driving them. And then we've outlined that in this transport section. What we're seeing there, and we've got some tables for both PT Dunedin and PT Queenstown, is that Dunedin is actually gone into deficit year to date, and we're forecasting it to create a further deficit by year end. So although the budget, it gets complicated in these both of these networks because they've both got the additional rates funding to repay the previous deficits. So it looks like they're in surplus. But what we're looking at is the forecast surplus actually going to be in line with our budgeted surplus? In Dunedin, we're forecasting that we're going to be 400,000, just over 400,000 worse off. Queenstown is the opposite. It's currently got in a better surplus position than we budgeted, and we're forecasting it basically to remain that way. And it will, the forecast there is that it will be 550,000 better off. The reason for these is we've outlined in there, Dunedin, we've identified some costs that weren't included in the budget. There was the increased service cost for Mosgiel Express wasn't in our budget, and the budget numbers also for bus services were uninflated. But inflation, obviously we do all of our year one uninflated, but they still should have included what's referred to as the CPI cost indexation, which is every quarter the bus companies, in line with the NZTA indexation numbers, charge us for quarterly CPI. So the upshot out of that is Dunedin cost is in the budget is missing about just over $3 million. Offsetting that, the budget also didn't include our receipt of NZTA grants from the SURF funding allocation. So that was just over 1.5 million. And also offsetting the cost, both networks have producing increased fare revenue above what we had budgeted. So when you look at that, if you look at that table in paragraph 18, the forecast, so the second one, the passenger services, so it's the one that we call the code 511, we're forecasting that the deficit for bus passenger services in Dunedin is going to be just over 700,000. But offsetting that, we had budgeted this year for infrastructure spend. NZTA didn't approve their funding for that, and council had the discussion around all of those items that weren't approved in November last year. That spend, you did agree that because we'd already rated for it, that we would spend the local share that we'd already rated, which is almost 500,000. No spend has actually occurred in that area year to date. So effectively that 500,000 in rates is creating a surplus. So there is some other lines that have got smaller variances, but effectively the overspend this year in bus contract costs, net of additional Waka Kotahi funding and fares, is being largely offset by the infrastructure spend that hasn't occurred yet and wasn't going to be NZTA funded. So we're ending up in our forecast is net position for Queenstown that will be created. We should be back to effectively a net variance to the budgeted surplus of 0, but we're going to be 400,000 worse off as our forecast.
So just in terms of the rating increase that was allocated to recovering deficit for public transport for this year, is that being used up to a certain extent?
No, because
this result.
No, because we're actually treating that surplus, rating, the deficit rating, and that deficit. This is one of the things that we're doing with the reserves, is we're going to actually completely segregate that old historic reserve. And if you like, this 400,000 that we've got here as a deficit is a new deficit that we have to treat separately, because going from this year, PT has a general rate funded allocation, whereas the old one is only being repaid by the old targeted rate payers. Yeah, so if you like, the previous old historic deficit or debt belongs to a different set of rate payers than any new deficit that's created. Yeah.
Kevin.
So with the infrastructure not work that hasn't been done, is that going to be done this year?
We've forecast that it won't. I think we've forecast for a small amount, maybe 100,000 of it to be we got that there in the.
Yeah, the short answer is no, it's not going to be done.
Okay, so therefore, your deficit, instead of being 400,000, is actually 900,000?
No, if you look at the second table in para 18, and it's the second line down, which is the 532. You can see there an expenditure. The full year budget was for 1.1 million. We're forecasting that we're going to spend 100,000 of that, so a small amount. And then what that means is that the additional surplus position is 439,000. So, and that includes still spending 100,000, but the year to date spend on that in that line in the table above is 32,000. So we're forecasting a small amount to be spent over.
So we'll still have 400,000 available in the next year for critical infrastructure improvements.
Well, based on this, I'm saying no, because you're net of all of these cost centers, you're ending up 400,000 in deficit. So if you then went and spent the 400, said no, we're going to carry it forward and spend it, you'd end up 800,000 to 900,000 in deficit. So we're saying here that surplus that's been created in that infrastructure area this year will be used to offset the overspend in the other cost centres in Dunedin.
We've rated it for infrastructure improvements.
Yeah, we've rated it for a different reason, but we've rated the same people. This is all PT Dunedin. It's all funded by the same rate payer. So,
I just wanted to test that point, because I had thought the general rate component, so we're actually 20% down, and that's fine. Is that correct? We haven't done a targeted general rate on this, have we?
No, because this is the total amount that we're short. Yeah, if we were to go, okay, 400,000, we want to rate for that. We need to increase our rates next year to repay that. 20% of that 400 would be allocated to the general rate. Yeah,
we chose to do it. That's fine.
Yeah,
I just wanted to test that. Look, sorry, I think we're into May now. Have we had this? I can't recall hearing about this Mosgiel Express not being budgeted before. Or have I missed something?
No, we haven't, because when we did the Q2 reporting, we were looking at the variances, and I think we noted in the paper that we were going to be doing some more deep dive into what's happening in the transport space, and through through reviewing all the actuals and then working out where our forecast would be, we've worked that out over the last quarter. So we didn't raise it at the previous quarterly report.
And so have we had any learnings in that process to understand whether this could happen again? I mean,
So I'll take that. So yes, there have been. So the headline is that through the work that Anita has been leading following those Q2 results, it's become apparent that the way that we were recording our contract commitments within transport was not of a standard that allowed us to easily translate that through to the budget commitments when we set annual plan and long-term plan budgets. So yes, there's definitely been some learnings around clarity and contract commitments, and the work that Anita's done along with some of Nick's team to actually unpick this has been very good. It's not a good position for us to be in. We were very deliberate in our LPP budgets to say that we were going to set balanced budgets in public transport to ensure we didn't end up in a position that left us with the deficits that we're currently repaying in Queenstown and Dunedin. So it is disappointing that we've ended up in this position in year one. And certainly, Kate, there will be some learnings there in terms of the way we record and ensure we budget for our contract commitments. There's obviously will be a subsequent discussion next week through annual plan because these contract commitments are in place and will need to be accounted for. So it's a different conversation that will be coming next week. But in terms of this year and looking at what has been budgeted within both Dunedin and Queenstown and how we might need to account for that at year end, that's the work that's been happening between Q2 results and we did flag at the time, not specifically that we felt there was an issue, but that something in transport needed a much closer look, and that's where we've landed with the Q3 results.
Thank you.
Got a couple of questions. Gretchen, I'll give you a chance.
Sorry, sometimes, this is a little bit slow to react. I just wanted to ask whether or not we felt confident that we'd assessed the risk, I suppose, of not investing in the infrastructure needs that the council had decided should be invested in this year, and when the appropriate time for governance would be to revisit that decision, given that the infrastructure spend was on the I suppose the most pressing health and safety type issues at bus infrastructure and stops.
So I'll answer that one through the chair. So we will be taking our year 2 and 3 budgets and reassessing that work program. So a lot of that work was as a result of the bus stop audit. And that was the direction from council just to prioritise that based on health and safety first. So we will be just recasting that program. I don't believe that there's any significant risk to not having implemented that in this year, but we will come back to you with what that looks like for year 2 and 3.
Okay, Elliot, you have a question?
Very much in line with Gretchen's question, but just wondering if I could give slightly more detail to anyone listening in on what that spending was gonna look like, and what if there would be any potential impacts there, the infrastructure spending.
So if you recall, the bus stop audit came to PATC, I think, late last year, and identified some of the challenges and had a risk matrix basically, and some of those risks are due to an old network. So we've got bus stops in places that if we were redesigning again, we possibly wouldn't, on corners, up hills, those sorts of things. So some of those bus stops were didn't satisfy some of the metrics, but they're things that we can't fix. And there are some other things like inadequate shelters, not a big enough bay, those sorts of things. So some of that work is we do with the TAs, and others we do on our own. So we're working through that stuff.
Okay, Kate.
Just testing. So I think it's covered in paragraph 20 to an extent. We've now deciding to do something that is inconsistent with the council resolution of November 2024, don't we actually have to recommend that to council to do that variation? It isn't in the recommended resolution.
So at this stage, the budget that was set was for infrastructure. Council will need to, the work program is not in place to deliver that infrastructure. So council still has a decision to make as to whether that money is carried forward for the purpose of infrastructure. But it would be delivered subsequent to year one because the work plan has not reached a point where we can invest in terms of the assessment of that bus stop audit. But yes, there is at year-end decision to make as to whether it's used as an offset for the unbudgeted expenditure we've got within transport or whether it is still invested within infrastructure. And then that deficit will increase, but will have to be managed in alternative ways. So there is a governance decision to make.
Okay, and so in paragraph 20, it suggests that this is offset. It should really read, this could be offset, and that will be a decision to be made later time.
Yeah.
Thank you.
Yeah.
No, I mean, it's just understanding that process. Thank you.
Yeah, just going back to the unbudgeted MOSCU on-demand services.
Express.
Express, yeah.
78.
So it goes live 1st of July, 2025. So on demand.
So just
sorry,
to
it's
clarify,
Express.
So separate to the new contract that is going live, this actually goes back to our contracting additional express services. And then through the inclusion of the Dunedin Public Transport business case and all the extended services that were in the long-term plan, and then having to withdraw all those services when NZTA funding didn't come through, we being staff there has been an error, and we just had to put our hand up for that. But and it is around the contract variation to deliver the express service, which has now been in place for a couple of years.
Started in September 2023. So it includes the Muscle Express. It also includes the services that reroute, that join Kings and Queens, Green Island. Those services are all wrapped into that 2022 variation that kicked off in 2023.
Thank you.
So I just want to be very clear that if council so decided to keep the $500,000 of infrastructure spend that we rated for as infrastructure spend, we would in fact be having a $800,000 or $900,000 deficit in Dunedin bus operation.
That's correct.
Thank you.
Yeah. Which is probably quite a good segue if there's no more on Dunedin into Queenstown, which are the same tables are there for Queenstown in paragraph 21. Queenstown's actually the opposite. It doesn't have a big it doesn't have a contract service like the Mosgiel Express that wasn't budgeted. So there is additional CPI. That network's obviously smaller, so it's not as big bigger impact. It's also Queenstown has the benefit of their fare revenue is higher than the additional amount is closer to sort of $500,000 in additional fare revenue that we're forecasting. So the net impact there is that there'll be a deficit in the bus service cost centre of just over 100,000. But the same thing, there was an infrastructure spend in the budget that NZTA didn't approve their 51%. So we were forecasting $1 million spend there. I think that one might have been for Mulligan's Road or something around there. Again, so that means that we've already rated for that. So the way that this works is that we're forecasting that there would be a surplus there of 550. Now we've noted that that we are aware there are some additional bus services that are being contracted to commence on 1 July 2025. We're now looking at, and we'll talk about this next week, putting those costs into next year's budget. In the previous versions of the budget, because we didn't have that, we haven't rated for it. So we're saying there's the potential there to carry that surplus forward to mitigate the need to increase the rates above where they are currently for council, for Queenstown, but we'll talk about that that next week. But as per your previous discussions, that's an annual plan discussion. Council could go, no, we still do want to spend that for 490,000 on infrastructure and deal with the not carry that surplus forward to offset any potential rates that might be needed next year.
It's the same process to ensure that decision around infrastructure spend or not is.
I'll leave it next week.
Yeah. So they're the two bus networks. Obviously, we've done quite a bit of work on that, and yeah, we're comfortable where we've landed with forecast for this year, and then there'll be discussions on what the impact of what we've discovered here and these flow through to next year's annual plan, and we'll have those discussions next week. Capital expenditure, the last couple of points that we point out there, we've just got a brief paragraph on capital expenditure, the balance sheet and the treasury report. Capital expenditure is under budget. What has come through in the biggest thing that's come through in the capital expenditure since the previous quarterly capital expenditure report is at the time that we did the Birch Kitchener sale, Port Otago gave us if you like, a matching invoice for a contribution to Whare Runaka, so that we didn't have to go and borrow money we just used the sale proceeds to offset our contribution. So 7.9 million exclusive of GST means that we've had about 6.9 million come through in the capital expenditure line for Whare Runaka. Now it looks like that line is over budget because we only had half of the total 11.2 in this year's budget, because the other half of that 11.2 was in last year's annual plan. So although it looks like we've spent over budget, it's only because this year's budget was only half of the total.
Okay. Michael, have you still got a question then around this?
Yes, I have. Yes, thank you. So just take me through that again, please. If the project is a year behind schedule currently, and you're talking about it being $1.4 billion over budget, are you saying that's just an accounting error or a way in which you apply your contribution, or it is because we are a year behind schedule, we are $1.4 million over budget?
I thought you said 1.4 billion.
Million.
Suddenly we're getting a much bigger building than I thought.
Well, it's still too much of a building.
No, where we're at is it looks against this year's budget, what we had in year one of the LTP, the amount that we've now paid as our contribution, 6.9 million, yes, is ahead of this year's budget of 5.6 million, but last year we had the other half of the 11.2 in the annual plan budget, which was 5.6 as well. And of course, we didn't pay anything last year. So effectively, but because the LTP and everything's locked in, we had a 5.6 million underspend in CapEx last year. This year to date, we're 1.4 million over. So we're still actually, if you compare the 6.9 million to the full 11.2 that we were spending, but over 2 years, we've still got the remainder of that 11.2 million still to contribute.
Okay. We rated for years for a new headquarters building in Dunedin, and that accumulated a sum of money, which I understand is the contribution to the council's contribution how much was that? How much did you have in that budget? In other words, of that 11.2 currently, how much is left?
Well, yeah, 11, so what do we got? 4.3, yeah.
So we've got $4.3 million as a result of the Birch Kitchener sale surplus in that account now.
No, the actual building reserve going into this year had about $14 million in it. We'd always only earmarked that we were going to be spending 11.2 as our contribution to the construction build fit out for Whare Runaka. So that was our agreed contribution with Port. That's still what we're forecasting to pay. The only reason these variances are there is just due to the timing of when we put it into our budget, which we put the first part of that budget into the previous financial year annual plan before this LTP. But once we've completed and we paid the 11.2, we always knew that there would be a remainder of the of what's in the building reserve. What we'd always indicated in the LTP and previous annual plans was that remainder gets transferred back to the general reserve in the same way that the gain on sale effectively goes into the building reserve. That will also go back to the general reserve as well. And then we'd always said with once we've completed all of this, we would be looking to increase the managed fund by an amount yet to be determined, because the return on the managed fund can be used to offset general rates, which will help pay for the rent on the once we move into the building.
Sorry, I'm a bit slow this morning. The $4 million from the Birch Kitchener sale.
Yeah.
That is part of the 11.2 contribution to headquarters, yeah?
Yeah, effectively, yeah, but it goes into the building reserve, and then we're factoring that we're taking 11.2 million out of the building reserve to pay for the our contribution to Whare Runaka.
No, I got you. So when you talk about the total of $14 million being in the building reserve, that's what you started off with. That was prior to the sale of Birch Kitchener, yeah?
Yep, it's what we started the year with this financial year. Right. From memory, it was about 14 million.
Right, so that would take the building reserve to effectively $18 million, yeah?
Yep.
And then from that $18 million, you've then allocated $11.2 million for the fit out of the headquarters building, of the new headquarters building, which would presumably leave about $7 million, will it?
Yeah.
In the building reserve, and you're intending to transfer that to the general reserve.
Yeah, and also, like, because we detailed all of this when we went through, and it might be easier if we brought back a report, because we've done this previously and we could summarize it. The other thing that will also go into general reserve will be the sale of and any gain that we make on the sale of Stafford Street. And as I said, then once it's in the general reserve, and we know what the finite numbers are, we'd said we'd be looking to increase the amount that we have in the managed fund to create additional investment revenue that can be used to offset the rate, the general rate and the rent requirement for having moved into the new building.
Right, so you're not thinking, well, I suppose this is part of another discussion, you're not thinking of keeping that in the building reserve for the potential future expansion of ORC buildings
Michael,
in the wider region.
Sorry to interrupt. I'm just wondering if I can make a suggestion that we bring a paper back to
Sure,
finance.
okay, all right.
Now, just appreciating that's probably more forward-looking than the report that's on the agenda today. Is that okay?
Yeah, sure. Okay, that's fine. Thank you.
So then statement of financial position and treasury report just outlines our effectively, the key things to note there are what our cash position is, what the managed fund balance is, which you just had the presentation from JB Ware, which is quite timely. Over the quarter, markets did take a bit of a hammering, but interestingly, where our fund has been fairly resilient and is actually we've maintained that balance, and since then over the last sort of 6 weeks since the end of the March quarter, it's actually we've actually had some good gains come back as well.
Elliot, yes.
Just going back to that paragraph 25, pretty easily guess where underspends might be for flood and drainage and IT, but I was wondering if you might be able to expand on what the operational property that 1.9 million underspend.
Yeah, so there's a combination of things in there. Operational property is where we pay for any other fit out costs. So we had factored in there that there'll be other fit out costs for the not the construction stuff, but what we put into Whare Runaka. So that's some of it, but there's also other operational property that we've got work going on or being looked at, but hasn't come to fruition yet, around Wanaka and Queenstown in particular. So yeah, we'd factored in that there would be a level of work going on outside of Dunedin. And although there's been good progress made on that, we haven't got to the point of actually spending the money yet.
I've got a couple of questions. Andrew, Michael, and then Alan.
Nick, I notice with the Port Otago dividend for this financial year, there's always a couple of $100K each quarter that accumulates in the dividend line, and it's obviously over and above what comes from Port Otago. I just wondered where that source comes from.
That's managed fund dividend.
Oh, okay.
So, and it should be that there should be some additional budget there, but all of the budget is lumped together in the interest income. So it's one of the things that we're just looking at doing is making sure that we split out the managed fund, because managed fund has 3 return components. It has the other gain or loss that sits down, in below the line, if you like, below operating expenditure. And that's just the market value of the equities. But we also do get cash, dividends and interest. We've just got it lumped together as one, and it's sitting in the interest. That's why interest looks, you got a variance there, but we'll split it out. But that's what that few $100,000 is. It's the dividends.
Thank you. Michael? You're on mute. Okay, should we move on?
Okay, no, sorry.
You there?
This is just so frustrating dealing with this technology. Anyhow, so the overall debt of $152 million, 127 of it is our borrowing to the Port of Otago. Is that correct?
Yep, on lending. Yep.
Yeah, okay. And so they're paying the interest charges of that.
Yep.
The $25 million then that we've got of debt, I'm assuming we pay interest, well, obviously we pay interest on that. Does the interest, I note the managed funds of almost 29 million, it's sort of a question that Councillor McCall asked before. If we've got a managed fund balance of $29 million and we've got a debt of $25 million, it wouldn't seem that the investment returns that we get from the managed fund compensate us for the interest we're paying on the $25 million worth of debt, does it?
Yeah, that's again, that's what we looked at when we go through the LTP and the financial strategy. The return that we actually get on the managed fund, the total return, including the gain and the cash and dividends and interest, typically is greater than what we are paying in debt, in interest costs on our debt. The other thing is the managed fund is, if you like, a general fund. We use the return on the return on the managed fund, and same as we do with port dividend, goes to offset general rates. Whereas the debt that we've got largely relates to targeted rate areas. So
yeah,
if you took one to replace the other,
yeah, I see.
move the benefit. But the underlying is it would definitely be something that we would look at if we were getting an investment return of 3%, but our debt servicing costs were 15%. You sort of question why are we holding that money? But the benefit at the moment is that we actually get a better return on our investments than we pay for debt.
What are we paying? What's our interest rate for that 25 mil?
Just under 5% currently.
Okay, thank you.
That's with local government funding, isn't it?
Yeah, like
Yeah,
LGFA.
which is the advantage.
Yep.
Kate, did you have a question?
I do have questions on the statement of comprehensive revenue and expenditure. Have we got to that point yet, or?
Yes, we've covered.
Yep. That's a minor one, but it's possibly for a change of reporting. The on page 15 of the agenda, we've got under transport the STEDs, which is the stock truck effluent disposal. And to my mind, they are better set under safety and resilience, both with safety on road and resilience, or under environment. And the
Yeah, sorry.
yeah, I mean, however it's funded. But I just wanted, when you look at, and I just want to make sure that people are very aware, including myself, because I could be forgetting about this, that public transport rate targeted and general components only relate to those public transport. Does it relate to the regional land transport planning function as well, or not?
No, regional land transport planning is general rate funding.
General rated.
Yep.
I do think at some stage in our reporting that we, and I don't, just to have a coding that we can really make it easy so we don't have to keep on asking these questions. The stock truck effluent disposal is under what?
What?
Funding, rating system.
It is it's general rate funded now. We changed that in the last revenue and financing policy. I think it used to, because it really only related to CODC, the ones that are there, but we changed it because it wasn't worth having a separate rate for it's a relatively small amount, so it's general rate funded now.
So just on Tom's leading a bit of the reason it sits within transport is because we can get a subsidy, so it needs to be allocated through transport to receive that. But we are looking at it. There's inconsistent management, and that's not a criticism of the way the TAs are doing it, but every TA has different contract arrangements, and so Tom's just working with our counterparts and the TAs who do manage them currently. We're just looking at what's the best regional model for the management of STEDs and just try and tidy that up. So it's fitting it in with other things. It's probably not high priority, but it's something we just want to tidy up in the next sort of 12, 18 months.
Or we could always give them to NZTA. Sure, they'd love them.
Nice.
Okay, I'm sorry, Alan, I missed you before.
That's all right. I'm looking at the capital expenditure table on page 21. In there for river management Dunedin, we had budgeted $1.4 million for the year, quite a bit of work, but not doing that. Just a bit of background on that one.
So that relates to a transaction regarding the settlement of an issue with the bridge on the Lindsay Creek. The other party in that settlement's not yet ready to finalise. That might still be some time away, but we'll just work through that when the time is right, and we'll carry forward through next year at this stage.
Okay.
Have any further questions?
Okay.
Look,
I think we all have to, and we've all had discussions about staff numbers, and just looking at the employee benefit expenses numbers on page 14 of the report, which are above budget to date and looking like they'll be, I mean, not a huge amount, but considering that I didn't think we'd had employed everyone we thought we were going to employ, just understanding why that is the case.
Yes, I'll take. So what we are doing when we need resource at the moment is looking at the best way to procure that resource. So we're very conscious of the staff budget. But where it makes sense for us to bring in a fixed term employee as opposed to paying a consultant, which sits in our operating expenditure, we are doing that. So things like GIS resources for projects, some of our other project resources, we financially can get a better result, and also just in terms of incorporating those people into our organisation to deliver that work better as fixed term contracts than they are as us paying for a pure consultant contracted rate. So it does mean that those numbers for the budget purposes sit with an employee benefit as opposed to sitting in other expenses under consultant costs.
Thank you.
Okay, Nick, I think that the summary report that you've attached here is really good. I had a really decent look through to see if I could identify any questions that haven't been covered. And generally, you've anticipated most of those. So it's a good report. Thank you. And if we have no further questions around our financials,
Yeah,
yep,
I've got
one more.
Customer, sorry. Yep. So on page 8, we've got Contour Channel grant funding. I'll just put the exact amount. They're both up $320,000 and $300,000. So is that additional funding, or is it just simply the timing of that funding arriving?
Oh, it's the funding that has always been talked about, but we never had it in the LTP because that funding was approved and came to us after the LTP was already set.
Yep. And at the bottom of that same table, we've got scheme oversight, higher staff costs of $180,000. How has that happened? Is that unbudgeted staff positions, or what?
Allocation staff time, I think. Tom.
Yeah, staff time in that code. What happened is there is in both river and flood, there is, if you like, an oversight codes, which is where time goes in there that isn't necessarily specific to one scheme or another. When we do the budget, of course, that area, if you like, is fully allocated out. But at this point, we haven't done a reallocation of any additional time that's gone in there that potentially is being offset by other underspends in the actual scheme areas themselves.
So an example of that, Kevin, is the next top line of the next page, where we're 920 positive because of less staff time and OPEX. So the staff time being recorded against codes it wasn't budgeted in, but what we are looking for from Tom and Brett is overall the staff cost allocation is consistent with what the budget was set at the start of the year.
Cool.
Yeah,
Thank
so
you.
that difference in offset is greater at the moment as we work through things like implementation of a new local extents and a whole range of other things which are genuine scheme oversight tasks that you undertake at a you're setting up processes or implementing processes you do at a group level rather than for the individual schemes, and then that will all get allocated out later on. I wouldn't expect to see that as a material trend going forward.
Thank you.
Okay. Yeah.
Better move.
Good. Well, actually, we've still got the performance reports to come. So can we? Okay, can do that. We can move the finance report be accepted, and thank you for that, Kevin. Seconder, Kate. Thank you. All those in favour?
No. It's not being accepted. It's just noting it.
Fine. That's noted. Yep. That's good. That's passed. Right. Oh, let's knock it off. Okay, sorry. I'll put it to the meeting. It has been suggested we have a break. But if you'd like to carry on, we can do that. We can have a break if you would like as well. So we'll carry on.
Come from keep going.
Right, let's go. What's my bed?
Well and truly, we have those online.
Welcome, Amanda. And yeah, pass it over to you. You'd like to introduce perhaps some new staff.
Yes, so morning, councillors. We're here today to present the Q3 performance reporting, but before the team take over that, I'd just like to introduce Joanne Greatbanks at the end here. Joanne has recently started as in a new position called Manager Organisational Planning and Performance. So that team has been created following Mike's departure. Within my group, I have reshuffled some roles and brought them together, and Joanne has come on board. So you'll start seeing Joanne in this committee, but also audit and risk, starting to look at business continuity and risk and internal audit. So big welcome to Joanne. And Vanessa, I'm not sure if you've all met Vanessa. Vanessa is our business partner, corporate planning. She is in Joanne's team and she'll be leading today's report. So I'll hand over to you, Vanessa.
Thank you. So this is Q3 of LTP Year 1 non-financial activity performance. I'll just clarify that this one is talking about period 9, and then the information that was provided yesterday was period 10. So just to give an overview for the March reporting, 39 targets are achieved, 3 are partially achieved, 11 are flagged as not achieved, and 6 are yet to be measured. These are listed in the discussion part of the paper, starting page 25. But I'll just talk you through the measures that have changed status from Q2 to Q3, and then we can talk about specific measures if you would like. So the measures that have changed to will not be achieved, the reporting of the action plan from the biannual survey. There is a further delay in the process of the future development strategy with QLDC. The draft air plan will go under another round of public engagement, and that's in conjunction with the air plan. New projects for selected degraded water bodies is also reporting not achieved following a council decision last November. There is a delay in presenting the Lake Wakatipu Natural Hazards Adaptation Strategy, and the 3 inquiries that was not met with communicating flood events within 20 days is shifted to also not achieved. The measures that have changed to at risk or partially achieved is the adequate staffing trained for regional wide emergency. And that is pretty much the overview. So I'll pass into the chair if there are any questions.
Okay, so we did cover off some of the stuff you said, and from what you're saying, we're looking at the month previous to what we saw yesterday. Is that right?
Yes.
Yeah, that's right. So it's just a quirk of timing. So the report you had yesterday was to the end of April. This is the Q3 end of March.
Yeah.
Very similar in terms of results. There might be a few things that change, but there was a slight difference in timing just because of when Finance Committee happens.
Okay, so well, we had a reasonable discussion yesterday about some of these performance indicators. I'll open it up though to the floor. Is there any questions?
That's weird.
Okay.
Yeah, not a question about the actual contents, but I'm just curious about around the reporting on strategic directions and like strategy performance that Hilary and the strategy team are working on, and just wondering if we have a picture, I guess, of how that will sit alongside this. Would these remain like 2 completely separate things or integrated somehow? Or, yeah, do we have a picture of that, I guess?
Yeah, so through the chair, I'm happy to take that question. I think, yeah, we're absolutely looking at the strategic outcome reporting, and we're hoping in February next year to bring you a strategic outcome indicators report, which will give you a sort of a benchmark baseline into how we're tracking against those strategic direction goals. There will always be a role for output activity monitoring. However, though, from an audit perspective, these are all put in the LTP and in the annual plans and subject to audit to make sure that we are delivering on those outputs. So we're hoping to, and this is something that Joanne will play a key role in, is bring those 2 together more. So there is more linkages between outputs and outcomes, but they will always be 2 distinct reporting frameworks.
I just got a question, which is actually, I should have asked yesterday, but I forgot that I actually had it there. And that was in regard to one of our measures, which is the percentage of resource consent applications processed in accordance with the RM, a target greater than 98%. Now, I know there's some complexity in the RM in terms of the days and whether the consent is notified or not notified, or whether there's hearings or not. But we were at the meeting last week with the irrigators, and some of the concerns raised by those irrigators was the length of time for the consents being processed. And I'm just wondering where that feedback falls within this performance measure, especially when we're hearing from them that some consents are taking 3 years to process. So
I'll let Joe talk to the technicalities of management working days and all the things. I'm happy to leave to her. But at a high level, and many of the councillors have been around the table before and will be aware of this, the framework we've operated under for the consenting of freshwater has been highly complex, and the work required from those applicants or consent holders, now they've all got consents, was significant to get to the point where they first consider a consent right through to are able to lodge it with the correct information, and then often go through hearing processes, in some case court processes. So I would acknowledge that it is a long period of time, and we would be hopeful that whatever the future planning framework looks like under resource management reform, that there is much more certainty in the application process. We can't, it's not about guaranteeing them an outcome, it's about ensuring that there's more certainty in that process, and that some of those, the length of time and the expense to go through that process is reduced. So hopefully that's what that new framework will achieve. But Joe can just talk a little bit around the formal working days, which is a bit relevant to this measure.
Yeah, and just further to that, so when the old deemed permits were coming in for replacement, they were staged, so they were done in batches, and that was done in agreement with the applicants and consultants at the time to ensure they progressed under the best pathway in terms of plan change 7 where it was in the hearing process. So that will also have factored into some of those timeframes that Richard has spoken about as well. In terms of working days, so that measure in the RMA, we report on working days. And that means that 100% is or 98% is the target. Those working days are different to calendar days. What we report on is the working days under the Act, and so those working days can be spread over a period of 2 or 3 years or over 6 months. But the time elapsed that we have to meet is on official working days, which doesn't include weekends and public holidays as well.
Just another one around, well, firstly, just quickly clarifying, am I correct that the punctuality percentage, the target of to 5 minutes is also like to 5 minutes late or 3 minutes early?
This is for the bus.
Yes, sorry, under the transport authority. Yeah, that's because the application. Sorry.
The question is page 33, measure 1, the percentages of scheduled services on time, punctuality to 5 minutes. Elliot was just confirming that there's a arrives too early and an arrives too late.
Yeah.
Yes.
Can you are they both 5 minutes?
I can't confirm that,
That's
but you did ask that.
Yeah, well, I was just checking. I think we said it was 3 minutes early.
We can
That's fine.
confirm
Okay.
that, yeah.
All good. And then around I was just wondering if we have an idea of when the report against the community survey action plan would come to a council meeting in the future.
Through the chair, we are aiming definite it will come to the partnerships and community meeting in June, at the end of June.
Okay, Kate, you were prepared to.
Yes.
Oh, sorry, Kevin.
So just further to the community survey action plan. So you're bringing that report back to us in June. So what actions have the actions been completed? I'm actually, yeah, just because we haven't got the report, but actually have we completed the actions or got them underway?
Yes, so the last community survey was done in 2023 and action plan came to council for adoption in 2024. What this report will do is report against those actions to let you know whether they've been done or not. My understanding is that most of them, are happy, were either ongoing BAU things or are things that have been completed. But we'll bring that full report for June.
Thank you.
And I guess an apology that it didn't come in March as per the target.
Yeah, cool. And further down that page, on the mapping of highly productive land, and we say that because there's indicated changes on the national policy statement of highly productive land, it's caused delay in adding highly productive land maps to the RPS. So because government has said they might be changing something, have we stopped doing that mapping?
So through the chair, we have always had the mapping done. The government signalled that they were going to remove LUC3 from the HPL definition, and that was where most of our work was going to be, in just in terms of refining that HPL. The other piece of work was the existing NPS allows for a bespoke definition, and so we had been working with our TAs around capturing things like the Stony Flats in Central Otago, Queenstown, that they wanted to protect as HPL. So the work is still progressed, we just haven't formalised it into a variation to the RPS or anything because of that change to the LUC3. So the work's going on, we just haven't formalised it until we've seen that final direction.
Thank you. Yeah, I do have one more, I have four more, but I'm only going to ask one because I lost a bet. Just going to emergency management activity over the last period, and I don't think it's because of lack of endeavour. We've seen that we've struggled to completely fill all the roles with trained staff to fulfill all our emergency management criteria. And being that is a critical activity, and we just see now a letter from Mr. Mitchell about some of his concerns. At what stage, or have we considered making that role of emergency management as a key component when we're hiring staff, that it becomes part of a role?
Negotiating with Tom, who's going to answer it. So we have had a discussion at ELT around inclusion of sort of events within position descriptions. We haven't gone there yet because we do get good uptake from staff. One of the things is the transition from someone showing an interest to being assessed as fully trained, and therefore can be counted as a person is a process. There's some training they have to go through, and we have to fit that within other work commitments. So it is prioritised. We only hold the trainings on a certain basis. And the thing that I test with Matt when we discuss it is if we had an event now, are we confident that we have a number of staff, even if they're not fully trained, that would enable us to operate an emergency coordination centre? And the answer is yes, we've got a good number of staff. Doesn't mean we shouldn't be aiming to have them all trained and to get back to green. The nature of I guess turnover in the workforce and the need for them to meet the required training, which takes some time, means we just haven't got to the actual number. But I am confident, and we demonstrated in October, that when we do have an event, we've got the ability to call on the right number of staff to respond.
Thank you.
Okay, well, it looks like we have come to a conclusion. Kate has moved that we note this report.
Happy to second.
Thank you, Kevin. All those in favour, please say aye.
Aye.
Against? It's carried. Thank you. And that wraps up the meeting. So thank you for your attendance, for your questions. It's good input.